Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back with the final episode of Facts versus Feelings for 2025. And we're bringing in the big guns, everybody. This is episode 167, wrapping up 2025 with Art Hogan. And I've got AKA the Boston Goat. I don't know if we can put that part on the title, but I really want to have that there. Art, Sonu's having some issues. Sonu might join us. He might not. But I think you and I can talk for 45 minutes. Art, I'm a huge fan. I'm honored. You're really excited, right?
I really am. And I think that the excitement comes from a couple of different places. I think 2025 surprised a lot of people. First part of the year, first quarter of the year, obviously we had a drawdown of almost 20% on the S&P 500 right into April 2nd. And that was really driven by a couple of things. I think it's really important to think about new administration coming in, four basic pillars, right? We're going to have less immigration. We're going to have the same corporate tax rate. We're going to have less regulation. And we're going to have tariffs. Unfortunately, of those four, you could make an argument that the worst medicine came first, right? So we're going to start with tariffs. And then everyone on Wall Street made an assumption that eventually we get to a place where the average tariff's going to be about 15%. And then Liberation Day rolled around and that looked like a chaotic mess on that poster board. And there was nowhere close to what we thought. 6 days later, the market bottomed because the administration said, hey, hold on a second. Let's start negotiating. And we cut a deal with the UK, cut a deal with the Eurozone. So that, I think, has started to alleviate when people are starting to focus on the other things that might be a positive. Less regulation. We've already started to see that pick up in M&A activity, which has been massive. Certainly the corporate tax rate is going to be beneficial. The fact that it's staying the same. And, you know, it's still, we don't know in terms of what the labor force looks like, the net impact of immigration, but we certainly know the economy needs to create fewer jobs to keep unemployment in check. And more jobs need to be created now to keep that unemployment in check.
So I don't know, Drew, if we can do this, but I hear like a doorbell. Let's on the YouTube channel. We've got two of us. Maybe let's open that door. Wait. Oh, there he is. There's Sonu. He's a little late, casually late. I see you. You guys wouldn't believe the technical difficulty we just had, but let's talk, Sonu. Can we hear you okay? Hopefully we made this.
Can you hear me? I can hear you.
Yeah, man, you look good. All right.
All right.
Well,
I am so sorry.
All right. So we're back to full strength, everyone. Art, we started high level there. We are so excited to have you. We do live in a world of compliance. Right. Give us your title, Art, and kind of, what you do all day. Besides, just dominate the Boston area.
Well, I'll tell you this, that our titles probably match online pretty well, and our end user aligns very well. So I'm the Chief Market Strategist at B. Riley Wealth. B. Riley Wealth is a very similar firm to what Carson does. We have financial advisors, and they use my help to do things like I run a couple of portfolios, both the growth portfolio and a dividend portfolio. We have meetings every week, both on Mondays and Wednesdays. I do events for, like you do. I do events for different financial advisors in their regions. And I answer questions that the clients have and try to make sense out of what's going on and separate the news from the noise. And unfortunately, with 24-hour media, there's a lot of noise and a lot of it's not important. And try to get everybody to understand what is important. So I put out a daily, I put out a monthly, and it's one of those things where financial advisors really, hey, what about, and there's always something, there's always some disaster du jour that they're concerned about. And I try to sort of make sense of that for them.
Well, I love it. So I'll go to you in 1 second here. Art, you and I have done multiple events together, some in person, some online. Always have really looked up to you over the years and consider you a friend and a mentor. And I'm just so excited that you're going to join us to wrap up 2025. We'll probably talk a little bit about 2026 as well. But Sonu, you made it. Congratulations. Let's start talking to Art. Go ahead, Sonu.
Yeah, I say one thing is like Ryan talks to clients. I talk to clients. You're doing the same. I am curious because the S&P 500 just hit yet another record high yesterday. We are recording this on December 12th. December 11th, it's what, from Ryan, from your data, 37th record high
37
this year. Right? But there seems to be a lot of angst. Sentiment doesn't seem to be positive. I am curious how you reconcile that. And What's the biggest question you're getting from clients right now? Is it like, are they worried about the market, or, what are you hearing?
So no, that's a great question. I think that some of the hangover concern about the concentration in the top 10 or the top 7 or the mag 7 or how you think
Was
about
that the bear? Were the Bears calling you there?
No,
Was
that was the
Bears?
Bears calling.
Yeah.
Exactly.
Now I joked. You're the interns. You've got 2 cute little doggies. They're getting a haircut. Was that the dog? Are the dogs done with the haircut? Who was that?
But let me know they're almost done.
Exactly.
So I would say that the number one question is, has this market gotten ahead of itself, and are we too concentrated at the top?
Mm-hmm.
And the easiest answer this year is absolutely not. And I'd say it 3 different ways. First and foremost, if you went back the last 2 years and looked at the percentage of stocks in the S&P 500 that were doing better than the index, this is the highest at 37% that we've seen. So that just tells you that we're not that concentrated at the top. If you look at it at a sector basis and say, okay, how many sectors are doing almost as well or better than the index itself? We're up to 5 this year. Last year we had 2, technology, communication services. So even more important to me is if you just take the Mag 7, which I'm sick of saying and talking about, and say, okay, how many of those
Mag
are
7 anymore? Is it 5
I know,
or 6
there really
or
isn't.
2?
I know. Mag 6 or the 10 AI darlings. I would say that the fact that 5 of those Mag 7 are underperforming the S&P 500 tells you that we're investing in other things. And I think that's so healthy, right? A broader market is going to be healthy for everybody. But that just needs to be described, because most of our clients are only listening to what the media wants to tell them, and the media wants to tell them Mag 7, AI, revolution, and everything that's going on, and forgetting that utilities, industrials, financials, healthcare has really picked its head up in the last 2 months, are all doing very well. And yes, tech and communication services are doing fine, just fine, thank you. But it's not as concentrated as people psychologically think it is.
Yeah.
And that's probably the number one question I get on any day.
Interesting. And I wonder if that's because people, Ryan and me talked about this. I wonder if people are concentrated, and because of that, when the tech story doesn't pan out, they're concentrated, even though the index really isn't. The index gains haven't been driven by these 5 or 7 or whatever, or 2, right? But because they're concentrated, every time the tech story comes out, for example, not a recommendation, Oracle comes out, they get tech, Corey techs, right? It's down 30-40% from October. And I wonder if, because people have made a lot of bets in that area, I wonder if that's driving sentiment lower, even though the broad market, exactly as you said, is doing well. All 11 sectors are positive.
Yeah, I would tell you this. I think that's a really good point. Where I get more concerned is when people start talking about being really invested in the very speculative edge of the paradigm, right? So, remember in November, the first 2 weeks of November, we had that 2-week drawdown. Everything that was risky sold off. So the NASDAQ probably was off 6.5-7%. The S&P was down 4.5%, something like that in round numbers. But if you look at the speculative edges, the things that are just the high-flying multiple of revenue companies, quantum computing, small nuclear reactor companies, lithium mining, uranium mining, all that hyper speculative, hope in a dream stuff was cut in half, more or less. And I think that was both a healthy thing and a wake-up call for people saying, all right, maybe I've gone too far in the speculative end of things. And even Bitcoin was down 35 or so percent in that time frame. So I think that period of time probably helped people rationalize that there's a broader market out there, and you have other choices. I think the other piece of the puzzle too, which is I think really important, is investors are now actually putting a value on the current leaders in artificial intelligence. Meaning, OpenAI comes out and says ChatGPT is this. All of a sudden, Alphabet comes out and says, oh yeah, hold my beer, Gemini's doing this. So at the beginning of this 3 years ago, when ChatGPT was the one game in town, everyone wanted access to OpenAI. Now they're looking at the results. Whose large language model is doing the best in the here and now? And there's going to be winners and losers. We're not going to have 7 large language models. And we didn't have 7 winners in the .com bubble. Someone's got to be Google, and someone's got to be Yahoo. Someone's got to be Amazon, and someone's got to be AOL. So we're starting
MySpace, maybe? Is there a MySpace in there?
Exactly. We're starting to suss that out. I think investors are starting to tease that out and actually giving appropriate valuations. The last thing I'll say on that is, if you look at the Mag 6, let's just take Tesla out of here and say that's not one of them. And look at the valuation they're trading at, and look at the gross margins they have. So you look at 6 names that have a 30 multiple, grow on average on average grow
And
earnings
that's
about being
okay for a growth stock, right? Like
50% revenue growth, 50% earnings
Yeah.
growth, and gross margins north of 65% on average for those 6 names. Yeah.
Mhm.
And that's why those multiples are reflective of why that group has come in or not outperformed the index, but at a very reasonable level. So I think that I think when you say are investors too concentrated in that, perhaps hard not to be because of the growth, right? Over the last 3 years. But I think that we're seeing much more of a differentiation and selectivity in that. I think that's healthy as well.
I mean, to that point, I
So-
wonder, like over the last month, Ryan, I'm sure you've heard this, and you're a Grok user. I know you use Grok.
Oh
I-
boy, I'm sorry. I'm starting to like
Yeah, and I split my time across,
alphabets.
a few of these.
Yeah.
But I know a lot of people who used to be on the Chat GPT side of things. They switched to Gemini or Grok, and I mean, this is all anecdotal. But
Right.
it seems like Art, exactly to your point, there's a broadening out of these anecdotes as well. Like, oh yeah, I'm not, Chat GPT is not working all that well. I'm using Gemini and Grok. It's working much better.
Right. And we're not even talking about Anthropic's
Yeah.
offer or,
Cloud and
yeah.
all that.
Mhm.
Yes.
I kind of sampling them all.
Yep.
And I just this weekend, my wife is like, how many $20 a month subscriptions do you need? And I was like, you bring up a really good point. As long as we don't have to get rid of ESPN, I'm okay. I'll whittle my way down to one.
Funny story. I've met your wife. We had dinner last month, and apparently she's the best investor in the family from the stories I heard. I'm just going to leave it there. I'm sure she'll like hearing that.
It's not even close, Ryan. Not even close.
This is big picture stuff, right? I think this is going to be a fun one to talk about. Surprises in 2025. I'll go first, then Sonu, and then Art. We'll all kind of pitch in. Again, we're recording this. What day are we recording this, guys? The 12th. So we're recording a little bit early because of the holidays and stuff. So let's talk about biggest surprises. I think, to me, the biggest surprise from an investments point of view and a psychology point of view is how surprised everyone got every time the market went down. Right? We had that near bear market earlier this year. We had the 5 or 6% pullback in November. Everybody freaks out. This was not going to be the first year in history where stocks went up every single day. I think there's 252 trading days a year. We were not going to be up all 252 trading days this year. Spoiler alert for 2026. It's going to be volatile. There's going to be headlines. There's going to be scary stuff. There's going to be uncertainty. There's going to be all that stuff. I think it just fascinates me how freaked out everybody gets every time the market just pulls back a little bit. On average, no such thing as average, but on average, you're going to see a 5%, mild correction 3.5 times a year, 3% or 8 times a year. On average, a 10% peak to trough correction. Yes, we had virtually a bear market. Tech was down even more, right down around 20%. That was not fun. That was pretty scary back in April, but we were on record saying we'd probably have as much as a 15% peak to trough correction this year, but we still said stocks would probably gain about 15% when all was said and done, and that's looking like hopefully we're going to be a little off on the 15, going to be up a tad more. That's what surprised me the most. Sonu, what was your biggest surprise in 2025?
I mean, I'll set aside Liberation Day because I was honestly shocked. I was in a plane flying from Dallas to Chicago when the president was up there. So that was a shock. I mean, just period. Like, I don't think I expected that. I don't think anybody expected that. So, but said, given that that was a shock for everyone, it's the everything rally, right? So we produce a quilt chart, our colleague Grant Engelbart, but everyone has a version of this. I'm sure, Art, you do too, showing all the different asset classes. Every year, there's, for the last few years, it's been growth stocks that have been doing well. It's up there. This time it's international. So that'll bring that. But at the bottom, it's always interesting what is at the bottom. And the bottom's usually negative. On a good year, maybe cash is up there. Cash is down there. This year, the bottom is cash. No surprise. But cash is up 4%. Everything is better than that. Bonds are up close to 7%. International developed markets and EM are up close to 30%. The S&P 500 is up 18%, maybe looking at 20% gains. Small caps are up 18%. I do want to get your thoughts on small cap. We'll talk about that. It's the everything rally. Managed futures are up. Gold is up 60%, right? Yeah. Everything's done well. I think that's
silver's doubled. Yeah.
That's my surprise. I mean, at the beginning of the year, I mean, obviously as asset allocators, we have to pick and choose, right? Which one do you want to be overweight? But we shifted to, close to neutral weight on the equity side between US and international at the start of the year, when Germany was talking about their fiscal spending, all of that. But yeah, everything's done well. We can't really complain, but yet sentiment is poor.
So, right. Art, is your answer the Patriots are really good? I think that's pretty surprising too.
Yeah, that is relatively shocking.
Yeah.
Second year for a young quarterback, and he's just proving to be. so valuable. I would say
Mhm.
mine is less of a surprise and it's more of a frustration. And I've been doing this for a couple of years. And let's just say in the 30 years plus that I've been doing this, I'm always shocked that the media wants to say that we're not going to have a Christmas this year. The consumer is dead. Christmas is dead. Nobody's going to spend any money. And my favorite piece of that is no matter how well Walmart does, it's always bad news. If Walmart's doing
I
well, that
love it.
means, oh, everyone has to go to Walmart now. And then they forget that they're such a good retailer and they're doing, as much online as they are doing in physical stores. So
Mhm.
those two things put together is just oh no, Walmart's doing well. That must be bad for the consumer. It must be bad for the economy. And I would say this, the media has canceled Christmas probably 15 of the 30 years I've done this. And it always seems to come, and we always seem to have a Merry Christmas, and they're doing it again this year. And if you look at the NRF or if you look at any of the reports, it's like, oh, spending's going to be down. I'll take the other side of that bet every time.
Yeah, and it's always
So
like the
what?
glass half empty view, right? Oh, what's going to derail the Santa Claus rally?
Right,
Right.
exactly.
So what we didn't overcome with small caps joining the party, right? The time we're doing this, small caps at all-time highs, mid caps at all-time highs, and transports at all-time highs.
Right.
Like those groups for like almost 4 years virtually haven't gone anywhere. Now they're joining the party. Art, I know you've got some thoughts on small caps, maybe mid caps, transports, kind of the groups that lagged, maybe cyclicals, wherever you want to take this. What do you see out there?
Well, three things on that. So I think the transports are really important for
Mhm.
them to actually do well. And I'm gonna show my age here, but Dow theory will tell you that the Dow making a new high and the transports
What was Charlie Dow like when you hung out with him 100
But
years ago?
he was a dapper dresser. I got to tell you,
He
one
was.
of the
He was
best
good.
guys
He was
in Wall
good.
Street.
Charlie Dow. He was good. Yeah.
So that I would tell you the transport's doing well. I think technically is something that we really needed to see, and not surprising. I think it's really important. I think the small caps you have to put in two buckets, and unfortunately the Russell 2 is what everyone looks at.
Yeah.
But if you look at the number of profitless companies in the Russell 2000, it's a bad image, right? It's like okay. There are times where profitless technology is doing really well, and a lot of them sit in the Russell 2. Importantly to me is if you look at the S&P 600 small cap index, that just broke out yesterday as well, and that's the profitable small caps. I'd rather focus on that and say that's very good. Part of this is due to, I would say, less regulation. Part of this is due, and so M&A valuations being priced in. I think the other piece of that puzzle, though, has to do with the fact that, yes, the Fed is going to continue to cut rates. They did again. They've done it 3 times. They likely will again next year. We'll get some real economic data now that we start to play catch up on that. I think that's going to be important. But I think that the last Fed meeting we had, Chair Powell tried as hard as he could to be hawkish, and he wasn't at all. And the summary of economic projections
Was he
wasn't.
trying even? Yeah.
I think he was real. I mean, he didn't try as hard as he did at the last meeting. He said, there's no predetermined, December rate cut, not even close. Well, as it turns out, it wasn't close. It was probably a 7-5 vote, but only 3 dissenters. But I would tell you, interest rates coming the right way is a big deal for small caps. I'd rather look at the S&P 600. That's the one we benchmark in our small caps. The Russell 2 just has a lot of unprofitable companies in it. And unfortunately, some of those unprofitable companies get popular, as we saw this year.
I want to. We'll put a pin in the Fed talks. I definitely want to come back to that and Powell and the outlook for Fed policy next year. But staying on the topic of small caps, just looking at the Russell 2000 year to date as of yesterday, so December 11th, is up 17.5% thereabouts. The S&P 600 is up only 10%. Right? And I think you ask any of us, quote unquote professionals in the business, which one would you pick? Like, obviously pick the quality one. That's what we do as well. Like the S&P 600 over all that junky stuff in the Russell 2000, but it's done well. And even on our team meeting yesterday, we were talking about this gap between these two indices on the small cap side. And I wanted to get your thoughts on, is the quality, like if you substitute S&P 600, if you'd say that's a proxy for quality small caps,
right?
Has some of that quality gone to the private space? There with less companies coming, up with IPOs, things like that. Like, we're just staying private, right? Yeah. And on the private side, maybe there's a quality companies and they're getting money from on the private equity venture side, all of that. I wonder, I don't know. I'm just speculating. I'm curious what you think.
No, I think that's 100% correct. When you think about the absolute polar vortex we've been in, and IPOs and the dearth of money, the absolute the flood of money in the private world, companies are staying private much longer. So that the ability for us to have 2,000 quality companies in the Russell
Yeah.
2000 is almost impossible, right? It's because so many companies are, are taking that private route and doing it for longer. That's not new, but it's certainly something that I suspect we're getting to a point where that has to change a bit, because a lot of the private equity and venture capital firms need to ring the cash register, need to either come out, do IPOs and or do mergers and acquisitions. So I think that's a very good point. It's that, but I would say that's true of the number of stocks that are publicly traded overall,
Yeah,
right?
yeah,
So it's been cut in half in the last 10 years because private equity and mergers and acquisitions. So we just don't have that many choices, which I would say, in a counterintuitive way, makes an argument for higher multiples, right? You have less
Sure.
supply.
Mhm.
So that's why the 5-year average multiple in the S&P 500 on a trailing 12 basis is certainly higher than the 10-year, because there's fewer publicly traded companies to actually invest in.
And on that supply front, corporations are still doing buybacks, so they're also actively reducing supply from that side of it.
No, 100%. 100%. Yeah. So it's all, it's all intertwined. That may well change. We may open the floodgates and see. I'm happy that we're not going through a 1996 to 2000 time frame where there was 783 publicly traded companies that didn't even have a business. They just put .com at the end of their name, RyanDetrick.com, and, opened up.
Hey, that's a
50%.
good one.
I
Don't you
know.
talk about that like Art.
Right.
Come on now.
But I'm just, we're not in that crazy euphoria phase,
Yeah,
because most of the players in this particular revolution and in this new technology are already publicly traded, or in the case of OpenAI, very well funded. So I think that puts us in a safer place. These are, quality companies. All of the hyperscalers are quality companies for the most part, making a lot of capex for the first time. And that's where people get concerned. It's like, oh, before these guys were monopolies and capex light, and now they have to spend capital, and who's going to do it best, and who the winner's going to be.
But I feel like it's still early, right? Like they're
Oh
not
my God,
quite
yeah.
like telecom level of, like capex heavy yet.
Yeah.
They could get.
So I think that you want to think back and say, Alan Greenspan said markets are getting irrationally exuberant in 96.
Yeah.
Right. So we went up quite a bit. Even if you got out in 99, you missed 80%. So it's, you have to be careful trying to time where we are and what innings we're in. But I would certainly say we're early, because the use cases are just now developing.
So this is episode 167 of Facts versus Feelings, wrapping up 2025 with Art Hogan, aka the Boston Goat. I'm going to change gears for a second here. We've hit the halfway point. It's amazing how fast this stuff goes. You do a lot of media. I do a lot of media. You and I were kicking around some media stories when we got to hang out face to face. What's some of your craziest like live on air experiences? You were going on CNBC like once a week when things were nuts. You gave a few of them to me. What just tell us a funny story about live TV.
All right, here's the craziest one. And this
Let's hear. I love it. Craziest one. This is it. Let's hear it.
This is one of my favorites. So this is at the very beginning, early 90s. CNBC is just coming out. Oh, by the way, the reason everybody had CNBC on their trading desk was because there was a guy that came on Wednesday whose last name was Dorfman, and he would have a stock that he was either going to push or pan. So the Dorfman effect was massive at the very beginning. So then every trading desk had to have that just to have CNBC on Wednesday to find out what stock he was talking about. Because you'd see massive percentage moves. I think he got drummed out of the business for insider trading or something. But long story short, that was the beginning of this, early 90s. So I get a call to do an interview with Maria Bartiromo. And apropos of nothing, we're sitting in a tiny studio, smaller than, where we're sitting now, glaring lights. And, I'm nervous. It's probably my second or third time. And I had walked over from the World Trade Center to New York Stock Exchange. The studio's upstairs, tiny. I'm sweating profusely, and, just one of those things. Anyway, the interview's going relatively well, and I think I had answers for everything. But apropos of nothing, she said, do you own any gold? And I said, just my wedding ring, and a pithy retort, because, if you talk about gold at any point in time, half the people in the world love you and half of them hate you. So it's like one of those things. It was like, anyway, I get back to my trading desk and my phone's ringing, and I see it's my wife calling, and she never calls me at work, right? And she was in the business as well. She goes just like this. It's platinum and you're an idiot. Click. That was my favorite story, and I probably tell it like once a year. But it was like one of those things like, oh yeah, that's a good point. I should probably stop using that joke.
So do you own any gold? No, it's kidding.
We actually have an allocation to gold, and we have for a while. But it's always been one of those things where we're never going to stop anybody from investing in gold. It's all about what you what helps you sleep at night and what you
Mm.
think your best diversifier is. So if you're 55 to 85, you're probably more comfortable with a diversifier in gold. If you're 25 to 45, you're probably more interested in a diversifier that has something like a crypto to it. So we're agnostic to how you diversify, but we'd rather, for most of our clients, we'd rather say, here's the percentage that probably makes you sleep better at night and diversifies your portfolio. And the best part about this is you don't have to buy it and store it somewhere. I think that there's probably two commodity ETFs that actually do very well and stay very tight to their prices and don't have roll cost. And one is gold and one is silver. So I think that, ease of use helps you sleep at night, helps diversify your portfolio. And we've been saying that, and it's interesting now that gold has done so well this year. We're finally getting people saying, "Oh yeah, you're right. I am sleeping better at night." And it's like, all right, sorry you had to wait 30 years, but yes.
Yes. But Ryan, go ahead.
Well, I mean, you want to go to the Fed?
Let's
we kind of started. Sonu, you tee that up. I know you like talking about the Fed more than I do. So look, watch how excited Sonu gets right now, Art. He loves talking about the Fed. I tell you, my eyes glaze over.
I have a similar problem with that, Ryan.
Here we go. Watch him smile. Look at him. And by the way, Art, Sonu had like no data, obviously, when the government shut down, so he didn't do anything for about a month and a half. So now he's back. So he's just so excited to be doing work.
I was on the verge of getting fired here because of
he had nothing to do.
Yeah.
No, look, I mean, this is not a peeve, but I was a little bit like taken aback by how much commentary going into this Fed meeting that, oh, this is a hawkish cut. Because here I'm thinking over 15 months, and everyone expected a cut. They were going to cut, right? A cut's a cut. But it's not just one cut. Over the last 15 months, they've cut 175 basis points, 1.75%. Over the last 3 months, they've cut 0.75%. So I'm like, what world are we talking about? Like a hawkish Fed here? They're cutting, right? And looking at the dots, I know they were dissents, but 8 of them see 2 or more cuts next year. 8 out of 19, 4 see 1 cut, but that's fine. That's still a majority, and that's fine if you have dissents. But policy still tilts it towards a dovish direction. So I'm like looking at all this hawkish, it's going to be a hawkish Fed. This dissent, like, but they're cutting. They cut a lot.
Yeah, I think that the important thing to look at. So the summary of economic projections was something that was useful after the financial crisis.
Mm-hmm.
And that was basically a guarantee of here's how we see the economy, but here's where you should expect monetary policy to be. That was the last time it was effective.
Mm-hmm.
In an economy that's actually normalizing and doing better, the dot plot is probably worse than the White Sox in terms of having a good year, right?
I'm on the north side of Chicago, so I'm like half a mile away from Wrigley Field here. So
to the extent, I'm sorry about that. To the extent that if you were to actually make bets on what the dot's predictive value, you'd lose every time. And there is a reason for that, because it's a median, and it's everyone, voter or non-voter, gets to pencil in where they think the Fed funds rates could be at the end of the year, agnostic of what changes in the economy. So to the extent that I think it's purposeful in that we know how the Fed thinks about the economy right now. I think they're wrong on GDP growth for this year and next year. They're light. That's okay. I'd rather have them be conservative than, irrationally exuberant. But they don't know how many times they're going to cut. I don't think anybody sitting around this table knows how many times they're going to cut. So to me, I look at it as more of a, hey, what are you guys talking about every meeting, versus I'm going to mark this down because we're probably going to do this. Unfortunately, the market makes too much of that and says, oh, this was hawkish because, the median is only 1 cut for next year. I was like, oh, really? You know what the median was last year? And you know how many times we cut? So it's just like, look at it in reality. Look at what they do, not what they're necessarily penciling in every time they drop a summary of economic projections on us.
No, I remind people that those summary of economic projections, that's just a forecast. It's their forecast, and it's their forecast under quote unquote appropriate policy.
Right.
And nobody knows what that is. And it's all forecast anyway. So you shouldn't take, that you should always take those with huge heaps of salt, forget grains of salt.
Right.
And I think it gives a view into their thinking. Yeah.
I think Chair Powell's done a great job of sort of distancing himself from that. He's been very vocal of, this isn't a prediction. This isn't a business plan. This is 18 people sitting around the table getting a chance to say, this is what I think by the end of the year. And so I think that's important. But I would say this. I also think Chair Powell, at this press conference wanted to deliver a hawkish, and he didn't. If you look at the summary of economic projections, he's got growth going up, he's got inflation coming down, and like everything else is like, so no matter what, I think the best thing that he said, which surprised me the most, was we're not creating enough jobs to keep unemployment in check, and that's why we're focusing on that mandate. And oh, by the way, we have a hard time calculating in an economy that employs 330 million people by the first Friday at the end of the month, how many have changed, because we survey people and we only get half of the results that we need. That's why so he actually said we're probably off by 60,000 jobs on a monthly basis, which means if we were 40,000 since April on a monthly basis, we're negative 20. And when he said that, I was like,
say that again.
Right.
So you said, like, and this is what Powell said, right? The economy is, losing jobs at the rate of 20,000 a month
on a monthly basis, and we'll probably see that in the revisions. Now, people always get tweaked by the fact that the BLS has to revise things. Imagine that your job is to figure out how many jobs changed in an economy that employs over 330 million people. Oh, by the way, you need it done by the first Friday of the new month on a monthly basis. So almost impossible, especially with the techniques that they use. They're obviously, trying to get better at this. But I think Chair Powell did a great job of saying, yeah, we're concerned about the labor market, and this is how concerned we are. Now, we'll get some more data in real time. We'll start to get back up to speed, but that is why we see revisions, and that is why the Fed is as concerned about the health of the labor market and less concerned about perhaps a one-time tariff impact on imported goods pricing.
That was great. Well, let me jump in just for a second, Sonu. So this is awesome, Art. I think we've got like 15 minutes or so. Definitely want to talk about maybe next year's views. But if you want to help us, everybody, give us a like, give us a follow, give us a comment. It can be positive or negative. One time, Art, a couple of weeks ago, I asked for only positive comments. I got in trouble. I'm not allowed to do that. So you can give negative comments. I always say save the negative for Sonu, the positive for Art and I. But on YouTube, please give us comments. It does help with those algorithms. Art, I want to change gears just a second again. You said no one knows what the Fed's going to do. I disagree. Because there are two people that work for you, and Drew will put their picture up right now. We'll get this from Art. You have two cute little doggies. They were interns, now they're analysts. I know they were bullish back in April, and everybody's freaking out.
Absolutely.
Talk to us about your doggies. I mean, they take a life of their own on social media. Every Friday, you say, what is it? Pencils down, beers up. Take a picture of your doggies. What beer are you going to drink this Friday, and how are you going to play with your dogs this Friday?
So that's a great point. So here's what happens. So the pandemic happens. I have to move from my office in New York, come home to Boston. Now, instead of being in a room with 50 or 100 people, I'm in a room with two dogs. So that I naturally started talking to them and naturally started calling them the analyst. And then one day I said to myself, I wonder if people are as bummed out as I am, missing that sort of noise and camaraderie and everything. So at that point in time, on a Friday, I decided to take a picture of my computer with my Bloomberg screen. I put a beer in front of it and said at the closing bell, pencils down, beers up. Well, the dog's heads just happened to be on top of my computer. So like they poked out and everyone was more excited about that than anything. So now it's just like, we don't care about the rest of this. Just show us the dogs and what beer you're drinking.
We don't want the Bloomberg screen. We just want the...
Yeah. So there's a local brewery that's a couple miles from my house called Stellwagen, and they have a beer this month called I Love Drake. That's our quarterback's first name, by the way. So it's a very
okay. I was thinking the rapper.
So it's like kind of a picture of him and his number. So obviously that one's showing up because we got a big game against Buffalo this weekend. But the interns, after calling them interns for 2 years, someone in HR, not at our firm but another firm, says, I think it's time for a review and promote. And I was like, a great idea. So they switched to the analyst. And the funny thing is, we do media all the time, and sometimes we can't control the background noise. I can't tell you how many times they've interjected, and most of the people that I'm talking to was like, oh, which one of the analysts was that? I was like, oh, that was Maverick. He needs to go for a walk. And everyone seems to be fine with it. As a matter of fact, I was on a year ago, and behind me, the dogs, I thought they were sitting. One was in a chair, one was on the floor, and they switched positions. And the anchor goes, Ziggy was in the chair, and he just jumped out, but Maverick jumped up. I was like, oh, maybe they are getting more PR than I thought.
Wow. Well, I wanted to have them on this time, but you said they're getting their haircuts and getting all cleaned up.
So they're going to be pretty.
I was wondering where they are. Okay, got it.
Yeah. So we've got about 10 minutes. You want to talk about 2026, Sonu? You want to tee that up?
Yeah. And Art, you, I think, alluded to, part of that. Rates are going down. That's a tailwind, especially for those cyclical areas like small caps. Actually, a couple of things. 2026. One thing that's lagged this year, and maybe this is a little bit of a surprise for me, given how well small caps have recovered recently, is mid caps lagging. Right. And mid caps have historically actually done really outperformed over a long time period, outperformed even large caps and even small caps. So I feel like, if you ask me about the US economy, I feel like mid caps capture the dynamic capitalism that America represents more than, yes, large caps are what everyone talks about, innovation, all that. Small caps are where some stories come in, but mid caps are a solid profit generator. And I'm like, wait, those are lagging this year. Why? And I'm curious, and we can get into 2026 as well.
Yeah, I think the mid caps falls in that same explanation that both of us just had on the S&P 6 versus the Russell 2.
Yeah.
Right. So when you think about the S&P 6 just getting up 10% on a year-to-date basis, Russell 2 up 17, I think it falls into that same category. Are we actually looking at the value agnostic of market cap versus the other stuff? And I think that's a piece of the puzzle, but I think both small and mid are going to have a great 2026. And I think that I would agree with that wholeheartedly. I also think the S&P 500 is going to have a great 2026, but I think it's going to come from places other than, the 10 mega cap technology
communication services.
They're going to do fine. I mean, they're going to have great earnings growth, and they're going to have, but we don't need to see necessarily multiple expansion in the 10 largest. We need to see broadening out into sectors that likely will perform. I think financials are going to have a great 2026. Think about everything that's playing in. Interest rates come down, net interest margin goes up, lighter regulatory touch, more trading activity, more M&A activity, more capital markets activity, all those things. And when you think about that, while the group has done very well, I think that has an opportunity to do really well. The group that I'm the most excited about heading into the new year is healthcare. Healthcare always gets booted around until we get to this place where it's like, all right, politics is not going to have as much impact as we thought. It's a political football, always, but we'll get to a place. But the excitement around new developments, even like Eli Lilly, who's the leader in the GLP-1s, has another coming out in 2026. And this one's going to, be the triple G. So not just GLP-1 and GIPs, but it's got another antagonist that attacks another hunger pathway, but it also gets rid of, in 50% of the people in this test, arthritic pain in your knee. So, and that's just one of the things that we're starting to hear about. So, but think about all the M&A activity and how big cap pharma needs to fill up their pipelines, and biotech is going to be in the target zone for that. So I think healthcare has a great year. In general, I'm taking up, by the time this comes out, I'll have officially published my target for the S&P 500. So I can tell you what that is now. It's 7,600.
All right.
How we get to that is $315 in earnings. Consensus is 310. And using the same multiple on a trailing basis that we've closed at for the last 5 years gets you to 7,600. I think that getting there is going to have a lot to do with 493 stocks as much as it does with 7 stocks.
What about Developed International? That's one we're kicking around, because obviously Europe's done great. The rest of the globe's done great, but will that continue? Because we saw in 2017, 1 year where the rest of the globe did great, and then the U.S. just ripped that baton right back. What do you think on that?
And actually, tangential to that, if you don't want to share, that's totally fine. But generally, how you're recommending allocating across U.S. versus international?
Yeah, so we have a 15% international. In the 15% of international, we had 10% in developed and 5% in developing. We're going to flip-flop that next year. Developed had a massive run, and Sonu, you hit it on the head. Germany started issuing debt for the first time since World War II and started increasing CapEx spending, and all of that. That drove all of the developed world. And I think that developing has a great chance to catch up, underperform this year, will likely catch up. So we're going to actually reverse that. So that 15% is going to be allocated 10% to developing, 5% to developed. And we think that's the rational thing to do heading into next year.
Got it. And, with respect to tailwind, so the way, without giving too much of our outlook away, our outlook's probably about 3 weeks out now at this point, if not.
Right.
About 3 weeks out. One tailwind I do see is like global activity, right? Yes, global markets benefit, or like global U.S. markets, but also U.S. markets, to your point, the remaining 493, like materials, more than 50% of revenue come from outside the U.S., right? If about 40% of S&P 400 revenues come from, outside the U.S., and a pickup in global activity I see as a tailwind, right? And then rate cuts you also mentioned. Talk about fiscal policy, right? What you see both in the areas of maybe defense, right? But maybe, it is a midterm year, so maybe you can wrap that in. Like, what do you see as a midterm year? What do you they've already passed the one big beautiful act. Those tax cuts will come into play. But do you think Congress does anything else, or the administration for that matter?
Yeah, I think that's going to be the reason that midterm years are kind of difficult in the beginning is because of the uncertainty around what changes around fiscal policy, and mostly not on the tax collection, because that's kind of locked and loaded. It's on the spending, and what would we forecast for spending? I suspect there's not going to be massive changes, but I think we're spending a lot already. I think we'll continue to sponsor things like infrastructure build out, which I think is a tailwind and will continue to be. I think that the fact that neither side of the aisle seems to be wanting to restrain any spending will continue to be a positive, and hopefully that their cost of debt's going to go down a little bit to service that debt. But I think in a real sense, I think you hit it on the head. I think there's we're going to continue to see sponsorship of defense, sponsorship of infrastructure build out, and sponsorship of energy production in an all-in phase, and I think that's going to be positive for those sectors. Defense, certainly. I think that the energy complex is going to continue to fare well. It's helped by the fact that we need a ton of it, right? Artificial intelligence is, showing us that our electricity demands can probably double by the time we get to 2030, 2035, and we need all of that. So I think the fact that a lighter regulatory touch on getting that accomplished, and government sponsorship of the appropriate developments there.
So you've had the honor to work with financial advisors a good chunk of your career. Sonu and I work with some of the very best financial advisors all over the United States every single day. What's like a bit of advice you've learned, Art, over the years that you can share with a financial advisor, whether it be working with clients, managing portfolios, all of the above?
Yeah, I think that's such a great question. And the amazing thing to me about financial advisors, the three things that I think that's very important to them, that should be important to them on an ongoing basis, is over communicate. Over communicating is one of the best things you could do. It's so easy. The natural human instinct of, I've got a diversified portfolio, I'm underperforming the S&P 500, and then explaining was like, well, let's back that lens up a little bit and see how diversification has helped you over a 5 or a 10-year time frame, and not just this 1 year when something was a 5-bagger. Over communicate that. This is why we have you here. This is how we're helping you. I think the second thing, on top of a ton of communication, is just be cognizant of the fact that when your client calls you and is concerned about something, it's okay to tell them that they shouldn't be concerned, but do it in a logical way. And there's always something that's going to come up. But remember a year ago, it was the central bank digital currency, and that was to destroy the world, and then it didn't. Or student debt repayment is going to crush the consumer, and then it didn't. There's always some disaster du jour that's happening.
Remember Cyprus for that one weekend in 2013?
Right,
we all freaked out over Cyprus, looking on a map where it is. Like literally everybody, you might not be around, but in 2013, we all freaked out for one weekend because Cyprus had trouble paying its bills.
Or describing to somebody why the yen carry trade mattered, and it doesn't matter anymore, right? And that's like, why did we blow up last August in the yen carry trade? Well, it was overextended. It's not anymore, right? So to the extent, it's like, Japan is actually going to raise rates for the first time in 11 years. So yes, there's things are changing, but not everything is as crazy or as dangerous as you might have just read in some blog or something. And I think that the hand-holding part of this job is much more important than the actual building of portfolios. It's the hand-holding of, this is why we're doing this, but it's also, here's some things you can ignore, and here are some things that we're taking very seriously. And I think that's the folks that do this the best build the most trust that way. And I've been thrilled to be able to work with folks that have been doing this for a long time, and the best are the ones that over communicate.
I love it. I think we've kind of hit the end of the road. In 30 seconds, how far your Patriots going to go, and how good your Red Sox going to be next year? What do you think? 30 seconds. I know we can talk all day.
Two answers. I think the Patriots are the real deal, and they're gonna make it all the way to the Super Bowl. The Red Sox have not spent any money in the offseason, and I'm very upset. They've let a couple of people go. Someone's going to Baltimore right now, very upset with what they're doing. So they have to do something in this offseason to build up, or else we're going to have the exact same team as we did last year and lose to the Yankees.
Got it. Now, last thing then, you kind of hinted at it, but for people that obviously, hopefully loved this conversation, I know I did, what are some ways the listeners can follow this cool stuff that Art Hogan's up to?
Now, the biggest thing that I do, and I think you do as well, is I'm on Twitter. Right? Twitter seems to be the biggest of the outlets for things that, I think are interesting, or things that I've said that I think you might want to hear. So I think the best way to do that is follow me on Twitter, and then, also on LinkedIn. But that's those are the two avenues that I use. My wife is like, why aren't you on, as old guys say, the Facebook, or why aren't you on the Snapchat or the Instagram? But it's I think for people that are actually looking for, advice, I follow a lot of people, including Ryan, on Twitter, and I think there's a lot of conversation that is very important for investors to stay on top of, because there's a lot of smart people that have stuck it out and are still on FinTwit and do a great job of disseminating things and distilling what's important and what's not.
I will say there's only one I guess, since Ryan's is the Ohio State, but
That's true. That's true. Yeah. We claim that one apparently.
But Ryan and I will be in Boston sometime early August, I think. So hopefully we can redo or re-up this conversation then.
Yeah, we'll do it in person.
Yeah, in person.
Yeah, we're having one of our multiple events throughout the year with our amazing Carson partners the first week of August. So hopefully it all lines up. We'll let you know when we're in town. Love to hang out, maybe do it again. But Art, this was amazing. We're big fans. I loved learning from you and watching everything you do. And we really appreciate you as we finished up episode 167 of Facts versus Feelings, wrapping up 2025 with Art Hogan, aka the Boston Goat. So everybody, I was incorrect. So we have one more of these, because next week is the 31st. So this is not the last episode of the year, although it kind of feels like it, because it's holidays.
This is the penultimate one.
Yeah, there you go. This is the most important one. I remember Breaking Bad, good a show that was, the penultimate. Those are always the best one. The best one's always the penultimate. Then the final one, they just cue it all up. So that's
right.
I think we did a good job by doing it that way. But Art, thank you as always. We'll definitely have you back. Everybody enjoy the holiday seasons and New Year's and all that cool stuff. And Sonu and I, we're going to do 52 of these next year. Yeah. We do them every Wednesday. We just might record it early because we know everybody likes it. And thank you, Art, for joining us a little bit early ahead of the holidays to do this. Everyone will see you next week. Enjoy the New Year's and the holidays. Take care.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.